Myles, just to pick it up on the last point, which is it seems as though, Europe has its own set of issues for sure. But when you move over to North America, it does appear that the United States economy is still quite strong despite the contracting GDP figure we saw this week. And therefore, of course, we can have different central bank policies in the United States and likely Canada as well because of our strong commodity business. But how does that play out in your mind? And how do you see the U.S. economy right now and what we might see going forward?
So the U.S. economy is already, first of all, I think it's still in okay shape. Despite the fact that we saw a negative GDP print, that's a little bit technical. The point is that, private sector investment and private sector in consumption are still very strong. And that's about 88% of the U.S. economy. What you saw in that latest GDP report where you saw, a drop in GDP of about 1.4%, that was entirely due to trade. And I don't think that's going to be sustainable. So if you just look through the numbers and you say, well, how's the organic health of the U.S. economy? It's still okay. Now, I'm not saying there isn't slowing. I mean, you're seeing it in housing, you're seeing it in trucking, you're seeing it in certain areas of the economy where, the interest rate increases already are having somewhat of an impact. But I don't think this is going to deter the Fed. The Fed still sees very, very strong labor markets. It still sees very low unemployment rates. It still sees, I think the risk of further upward pressure on wages. So I think the Fed's going to continue to tighten policy. And I could say the same about the Bank of Canada. And if you just look at what fixed income markets are expecting for the remainder of the year, I mean, they've got the Fed raising rates another 200 to 250 basis points, or 2.5%. And in Canada, it's similar. It's 200 basis points. So, the markets are pretty convinced that both the Fed and the Bank of Canada are going to be tightening policy settings for much of the remainder of this year.
And you seem to believe that they will absolutely do that. I guess the question, though, is, are they going to make a policy mistake? And you do point out, of course, that in most tightening cycles, they actually do make a policy mistake and cause a recession.
So it's too early to say that right now. I'd say that, the next 50, 75 basis points probably will not be a mistake. When you think about mistakes historically, they typically get flagged by the inversion of the yield curve and in particular, the spread between the 10-year Treasury yield and the 3-month T-bill rate. And there's still a big spread there. So I'm not sure that, the next 50 to 75 is going to be a mistake. But, as we get later into this tightening cycle, we have to be, much more sensitive to what the central banks are doing. And, that's not to say that the markets aren't feeling some indigestion from this tightening cycle. Let me just say that. I mean, we know that, equity markets have been struggling, bond markets have been struggling. And in fact, if the year closed out right now, both the 10-year Treasury would have a negative total return and the S&P would have a negative total return. I look back to 1970 and that's never happened before.
Really?
Yeah, never. No, not since 1970. When both the 10-year Treasury yield and the S&P were down on the year.
So what does that mean? And maybe
it's tough, Catherine.
What's that?
It means it's tough. It means it's really tough out there. Yeah.
Well, it's interesting as well, just, taking a look at the first quarter earnings results and you point out that the overall growth is, 6 point something percent so far. But that if you X out commodities, I think it's 1%. It's not a lot of growth. And that most of the sectors are actually down. Yeah.
I mean, look, relative to expectations, companies are doing fine, but I think it's something like 75% of companies in this quarter's reporting season in the U.S. have put up numbers that are a little better than expectations, but the aggregate growth rate is not great. Now you're coming off the prior quarter, which was huge in terms of earnings growth, so you're getting a little bit of base effects here. But yeah, for sure, earnings growth is slowing, and it's slowing meaningfully, just like the economies are slowing meaningfully. And let's just be. I think that's part of the indigestion problem, where we're sort of ratcheting down our growth expectations, and that's weighing on PE multiples, as are rising interest rates. And so that's what's causing a lot of the problem, or a lot of the volatility in the markets. But I don't think we're heading into earnings recession. I don't think we're heading into economic recession right now. Talk to me in 5 or 6 months and we'll revisit that thought. But for now, I think this is all about, changing our growth expectations, resetting our expectations to something that's more realistic. And again, in doing so, we're creating some volatility in markets.
Absolutely. All right, we're going to pick it up right after the break.